Hello, I'm Debra Brede of Brede Investment Management Company. Today I will discuss ways to stretch your IRA. In the next 15 minutes we'll cover stretch IRA basics, steps that you can take to stretch your IRA, whether stretch your IRA is right for you, and how to get started to stretch your IRA. The stretch IRA is not a type of IRA. It is a distribution strategy that you can set up for a traditional, rollover, or Roth IRA. It extends tax-deferred growth potential on traditional or rollover IRAs, and it provides an extended stream of tax-free income on Roth IRAs. The next step in stretching an IRA is to name beneficiaries who are young and who can receive income over a long period of time after the death of an IRA owner or the IRA owner's spouse. The key advantage of a stretch IRA is that IRA assets have the potential to continue to grow tax-deferred over the period during which distributions are being made to beneficiaries. Before you consider a stretch strategy for your IRA, ask these questions. Number one, will you need your IRA to generate income in your lifetime? If you and your spouse will rely on your IRAs for retirement income, a stretch strategy may not make sense for you. If your spouse may need your IRA for income after you are gone, you should name your spouse as beneficiary and implement a stretch strategy by naming a young beneficiary for any remaining assets. If neither you nor your spouse are likely to need your IRA, a stretch strategy may be right for you. Number two, do you have young beneficiaries who could benefit from a lifetime of potentially increasing income? Young children or grandchildren of family members with special needs? If the answer is yes, consider a strategy that can help them stretch income over their own life expectancies. If the answer is no, consider bequeathing your IRA to a charitable cause or alma mater. A nonprofit that inherits an IRA is exempt from federal and state income tax. Keep in mind that an IRA owner may change beneficiaries at any time. A stretch IRA has three main benefits. It can help you, number one, extend the life of your IRA to provide income for your spouse, children, or grandchildren. Number two, it can maximize potential tax-deferred growth of your IRA assets. Number three, can provide income for your heirs, tax-free with a stretch Roth IRA. It takes planning to position yourself to effectively leave a stretch IRA for your heirs. Here are 5 steps that can help you maximize the potential benefits of a stretch IRA. The foundation for a stretch IRA begins during your working years. As you can see by the chart on this slide, you can accumulate more than $1 million in an IRA, earning 7% annually if you start early and contribute every year. Double that to $2 million if both you and your spouse contributed and earned 7% annually. Contribute the maximum to an IRA each year, even if you don't think you will need to save additional money for retirement. Remember that your spouse can contribute to an IRA even if he or she does not work outside the home. Although you will be eligible to take penalty-free withdrawals from your IRA after age 59 and a half, it is a good idea to delay distributions from your IRA as long as you can. Look at the difference it can make to your total wealth accumulation as shown on this chart. The bottom line shows the impact of 5% annual distributions beginning at age 59 and a half. The starting value of the IRA was $100,000. After 11 years of withdrawals and an average annual compound return of 7%, the ending value is $102,393. The top line shows the impact of delaying distributions to age 70 and a half. After 11 years and a 7% average annual return, this $100,000 account is worth more than double its starting value, or $210,485. After you reach age 70 and a half, you will be required to take minimum distributions from your traditional IRA, even if you are still working. Minimum distributions are determined by an IRS formula based on your life expectancy. If there is a significant difference in age between you and your spouse, that can also be a factor. If you take minimum distributions and no more, look at how much larger the value of your IRA is after 15 years. This chart shows the difference between 6% annual distributions and minimum distributions. If you keep your distributions to the minimum you're required to take, you can have the potential to accumulate significantly more for future generations. This may be the most important slide in this presentation. It demonstrates the ultimate stretch IRA. If you leave your $250,000 IRA to your estate, its value after income tax is paid as $180,000. If you leave the same IRA to a 10-year-old grandchild, the child can stretch the income over 82 years of life expectancy. After paying taxes, the total lifetime value of the IRA distribution is more than $5 million. The message? It is essential to name a beneficiary if you want your IRA to be distributed in an optimal way. Name young beneficiaries to really stretch your IRA. It is very important if we are discussing a stretch IRA to understand that we must designate our beneficiaries in such a way that they are afforded the opportunity to take required minimum distributions over their life expectancy. In order for a beneficiary to stretch the IRA, the following conditions must be met. Number 1, all named beneficiaries must be individuals. Number 2, individuals must be a beneficiary as of the date of the owner's death. Number 3, individuals must remain a beneficiary as of September 30th of the year following the owner's death. It is very important if you are naming your estate as a beneficiary that you understand the cost to do that with respect to the stretch. If the estate is the named beneficiary, your heirs will not be given the opportunity to stretch over their life expectancy. In many circumstances, they will be required to distribute all of the money by the end of the 5th year following your death. Accounts where the beneficiary is not an individual, such as an organization or the estate, will be treated as having no designated beneficiary and have to take lump sum distributions. If you are naming your trust as the beneficiary of your IRA, the trust must meet certain conditions in order for any stretch to occur on the beneficiary's life expectancy. If the 5 conditions are satisfied, your trust will qualify for see-through provisions and you can base a stretch on the oldest trust beneficiary's life expectancy. This could be a disadvantage if you have several beneficiaries and there are considerable age differences between them. You may want to consider alternative designations where possible. If you named a trust as your beneficiary and your surviving spouse was named to receive 1/2 of the asset through your trust, and children from a previous marriage were receiving the other 1/2, then you could look into the trust and look at the wife's life expectancy as the oldest trust beneficiary and use that to determine what the stretch period will be. In this example, the trust would be able to stretch distributions over a 21-year period. When you can, you may want to consider naming beneficiaries by name when dealing with qualified assets and naming the trust as contingent beneficiary. By naming the individuals in the previous scenario outright, you allow the children to stretch their interest over their own life expectancy. They more than doubled the stretch period. Additionally, the wife will now have the opportunity to roll her portion into an IRA for herself and defer distributions until she is 70 and a half. She can then name her own beneficiaries to inherit the money and then stretch over their life expectancy. If you are considering naming a minor child or grandchild as your primary or contingent beneficiary, you should consider alternatives to naming the child outright. If a minor inherits money, court intervention is typically required, so the asset is essentially frozen until the courts document who can act on behalf of the minor. This can become very timely and costly. Not to mention, when court intervention is involved, there is commonly an ongoing requirement of an accounting back to the court with respect to the asset. In the absence of a trust, consider using the Uniform Transfer to Minors Act. This act allows the transfer of money to occur at death and is therefore a valid beneficiary designation. Decide who you would like to control the asset on behalf of the minor until they reach the age of majority. Keep in mind, you have the ability to change this individual up until the asset is transferred at your death. Simply indicate the custodian you would like followed by the minor's name, UTMA, and the state whose act you are adopting. So if the child inherits the asset, proof of age is requested. If the child is under the age of majority, the custodian has immediate access and control on behalf of the child. If the child is over the age of majority, the child has immediate access and control over the asset. It is also very important that we know mechanically how our beneficiary designations work on all of our assets, and we don't make assumptions. Let's consider the following scenario. You have a father naming his 3 children all as primary beneficiaries in equal shares. He also has grandchildren from each. In most designations, if one of the primary beneficiaries predeceased him or disclaimed their interest, their share would go to the other primary beneficiaries. All primary beneficiaries would generally have to be out of the equation before any contingent beneficiary receives anything. In most designations, if one of the primary beneficiaries predeceased him or disclaimed their interest, their share would go to the other primary beneficiaries. This means you could be unintentionally disinheriting part of your family. You may want to consider customizing your designation to include persterpes. This way, if one of your primary beneficiaries disclaims or predeceases you, their interest would go to their children, not the other primary beneficiaries. This may be more in line with your goals. When you convert your IRA to a Roth IRA, you will owe federal and state income tax on the amount of the conversion. For this strategy to make sense, you should be able to pay the taxes out of your taxable savings. This can be a smart move because it will, number 1, reduce the amount of your taxable estate, and number 2, create a lifetime of tax-free income for your heirs. Unlike traditional IRAs, you will never be required to take distributions from any amount from a Roth IRA in your lifetime. Your heirs will be required to take minimum distributions based on their life expectancies. I hope this has helped you understand the basic principles of a stretch IRA. However, there is much more to creating a successful stretch IRA strategy. To be successful, a stretch IRA must satisfy IRS regulations for required minimum distributions. Because a stretch IRA is a sophisticated, complex estate and financial planning strategy with implications that can carry over many generations, please contact me to discuss your specific situation and how a stretch IRA may benefit you.